The market has opened looking fairly mixed. Remember, we just came back off a very poor week where we did see incredibly nearly red right across every single company in the S&P 500. And one industry that has been worse for wear is the semiconductor space, where, as we saw just over the last few days, the likes of Nvidia, Broadcom, AMD, and many others that aren't captured here have continued to fall. Now today we're going to focus on ASML, one of the worst performing in the space, in fact down nearly 30% just over the last 6 months. We're going to run through a lot of information, why we continue to buy this company. We're going to say why does it look undervalued, and some bearish indicators that we need to be prepared for in case this company doesn't produce as strong as the forecast management have discussed. So first thing that we need to draw your attention to is the earnings that they reported last month, and we can see just from the heading alone it was not great, as in fact 50 billion was wiped right across the face of their market cap. Management came out for their full year guidance for 2025 at around 30 to 35 billion, and we can see that effectively this was at the lower half of what they had previously guided for, so the market didn't like that. There were a few other things that we will consider, and one strange element of their reporting was in fact the schedule, in which they reported earlier than when they were meant to, and they put this down to effectively being a technical error. So let's have just 2 points that we do really want to bring to your attention as to why this company at that part of the period did decrease. The main one here that we do see is that their net bookings for the September quarter was around 2.6 billion euros. That is significantly, and we mean a very significant drop to the 5.6 billion that the market expected. So not only have they lowered, or you could say narrowed to the bottom end, their full year guidance for sales, but also for the net bookings for the quarter of September, it was in fact more than 50% below what the analysts were expecting. On top of that, we can see that the CEO has mentioned that it appears the recovery is going to be more gradual than previously expected, something again just to factor in and maybe consider when we do look at our margin of safety later on in the episode. The other bearish indicator here is around China. Now understand that the US government, we don't know exactly what they are going to do, especially under Trump's term. They are going to put in some more export controls. How much they do in terms of tariffs as well as other areas, something that we do need to consider, because in the previous presentation for ASML, they mentioned China sales was around 49%. That is pretty much half of their top line. Right now though, they're saying they expect this to be around 20%. So just something we want to bear in mind. What it seems to have been the case is that China knew that these tariffs were coming in, knew that controls were going to be getting tighter, and may have essentially upfront bought a lot of the products that they needed, and therefore we are seeing a level off from the 49% to around 20% of their revenue for next year. Again, lots of considerations. This is one company we are bullish about, but we also need to look at both bearish and bullish scenarios. We also know just last week, management came out and said they expect their top line sales in 2030 to be around 60 billion. The market did like that. We saw an increase to the share price, although those gains have now been eroded by the market just over the subsequent trading days. And we can see here another article talking about how ASML maintain their very bullish outlook for 2030, and a few things that is important to understand with where they do expect this. First one, well, they anticipate sales in 2030 alone to be around 44 billion to approximately 60. That is quite a wide range, but again, something that is interesting to note when we see what their top line is for 2024. And ultimately, they believe that the semiconductor market, specifically in relation to ASML, will increase at an annual rate of around 9%, and they believe, in fact, AI demand will help global chip sales to around 1 trillion by that period. Now, for those that don't know, ASML is very important in the world of semiconductors, as it is the only company in the world that makes the kind of lithography machines that help semiconductors in turn produce advanced chips which power everything, as we can see, Apple smartphones to Nvidia's AI accelerators. So they do have what we would consider a very wide moat, but you also get people in the community who believe that this can be penetrated and then affect their total top line moving forwards. And always great to see the company does forecast a gross margin between 56 to 60% in 2030. We're going to come onto this because high quality companies, as we've said before, increase both their top line as well as their margins for that efficiency, something that we have seen from ASML in the past. Final thing to note here, ASML is currently also doing their ongoing buyback, of which they have only completed 14%. Now let's just go back into the company itself. It is down nearly 30% over the last 6 months. Over the last 12 months, down around 2%. Over the last 10 years, though, it has massively outperformed the S&P, as we will come to show you, up 528%. In fact, if you reinvest dividends, it will be up higher, and we can see quite some way away from all-time highs just in July 2024, where it was trading at $1,110. Now, we also get a double buy signal from Seeking Alpha and Wall Street, a hold from Quant. It does pay a yield just over the 1%, and the forward P sitting at just under 33. Now, if we take a look at their earnings expectations moving forwards, every single quarter, in fact Q4 all the way to Q3 2025, they're expecting double-digit growth to the EPS, and when we look back for ASML, they have significantly outperformed on the earnings per share, 100% historical forecasting accuracy. On top of that, over the next full year, they anticipate EPS to hit 23.70, in turn lowering the forward P to 27.8. Now, before we do jump into the financial metrics to see where this company sits on ROIC amongst other important factors, we just want to show you a few slides, very important, from that investor presentation that they did release just a few weeks ago. Now, as we can see, the first slide does mention that they're expecting for this full year 28 billion euros, something important to understand when we will compare it against the previous year. And they do believe ultimately that the growth in semiconductor markets will continue. Remember, they do have a wide moat for those machines, which they believe will continue to drive the demand for their own products as well as their services. We can also see that they do believe that the demand continues to grow, and that is why they are looking to improve their supply chain, being able to meet their current capacity as well as what they believe as an increase in future demand. And we love this. We'll show you these metrics as well, but they also in here point out their capital allocation in terms of returning excess cash to shareholders through both share buybacks as well as increasing the dividend. Now, a few things here that we do really like about this company. We'll show you in a different format so it does look clearer, but their margins are very, very high, and in comparison to the sector median, again, we'll show you that later on, they are very, very attractive, something we do look for when we want to consider companies. Not just increasing revenue, but margins are incredibly important. Now, in terms of their sales from the previous quarter, it is up around 4.8 billion to 5.9 in the latest quarter, and we can in fact see the one driver, or one of the key drivers we would indicate for the drop in the share price, is that their net system bookings went from 5.6 billion in Q2 into the Q3 more recently reported to 2.6 billion. So remember, with companies there are lots of things that we do need to consider, but one thing we love are the capital allocation of this company. Not only the dividend, which has been increasing at a very rapid rate, although as we will point out it has started to slow down, but they also do factor in share buybacks, which when we do look at it from a percentage on a year-on-year basis, ASML put more of the capital allocation in return to share buybacks as opposed to the dividend. Nonetheless, we still like this, as one way or another as a shareholder you are benefiting significantly. As we can see as well for the next quarter, around 8.8 to 9.2 billion in terms of that top line, and the margins, remember, in fact for 2030 they're expecting this to increase around the 60% mark, looking very, very good. 28 billion for the full year, and as we can see, always think about margins, especially in companies that maybe we don't cover that sit within your portfolio. You want to hold companies with very, very attractive margins. Now let's get into some of the underlying metrics from ASML. Firstly, dividend safety score 82, very safe. Double undervaluation, which we will cover, but as we mentioned, they do increase the dividend at a very rapid rate. Unfortunately, July this year, 4.8% is just above the inflationary 4%, therefore we were disappointed, and we'll show you the historical increases as well. So October, so the back end, in fact, just a couple of weeks ago, reaffirmed that a dividend cut for ASML is highly unlikely. And as we will show you, in terms of the key metric, this is from the 07-09 Great Recession, they actually cut the dividend. They had negative 56% sales. That was below the average of the S&P. And in fact, the return itself, though, was pretty much bang on, negative 55, the S&P itself, the exact same. As we mentioned, over the last 5 years and over the last 10 years, they had been increasing that dividend at a double-digit, very, very attractive rate. And we can see they have been increasing those dividends consecutively for the last 14 years. Now, based on the 5-year average of the forward PE, when we zoom into over the last year, this blue tunnel indicates the fair value. Right now, in fact, over the last month, it has been below that, which indicates severe undervaluation. If it was at the lower end of the blue tunnel, that would be undervaluation. Right now, we can see that it is severe, completely out. But do remember, we don't look at any of these models in isolation. We will conclude when we do come to our own towards the end. In terms of dividend yield theory, this states a company is undervalued when the current yield sits above the 5-year average. 0.99 above 0.83, that is in fact another signal. And then when we get to essentially the free cash flow payout, as always, we draw your attention to free cash flow data over earnings because it is susceptible to manipulation by management through accounting. Below 50%, remember our target is here to ensure that management are able to offer continual double-digit increases. So no surprise in 2023 that it was very mediocre, 74% free cash flow payout. Nice to report, 13% over the next 12 months. So next summer, we do hope ASML can offer a very attractive double-digit increase. We then move on to the free cash flow per share, where we do see rapid increases from 2014 to 2023, but we do want to point out that it has dropped significantly from 2021 to 2022 and again in 23. Nice to report though, in fact, triple expected over the next 12 months to $23.10 per share. We then move on to sales growth, 3 to 7%, at the bare minimum 3 to 4, just to keep up in line with inflation. In fact, nearly double digit every single year, looking very strong, although we do have to point out on the trailing 12 month, it does look like there will be very minimal, if any, growth for that full account. Then we get to the numerical format, where we see in fact it has quadrupled over the last 10 years, and what they've also done and expected to continue to do, as we highlighted at the beginning of the episode, is returning the excess cash through those share buybacks. In fact, they've bought back around 10% from 2014, and remember, what this ultimately does is give you a larger portion of control of the company you are invested in. ROIC, our favorite metric, 10% or more, or 12 for this industry. Give us faith, management are able to effectively allocate their capital. Looking very good, last 3 years absolutely phenomenal, in the mid to upper 40s. Investors as well as those shareholders will love to see that, and in fact make it very attractive for those that want to consider. Now remember, on the operating margin, we want to see efficiencies not just above 16% for the industry, but we do get that, 26 in 2014 to 33 in 2023. And the free cash flow margin, no complaints, looking very good and healthy, a little bit inconsistent, nonetheless above that 5% minimum. Then we move on to the net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. Below 1.5 is what we want to see for the industry. Remember, the numbers below, or lack of, are the number of years it would take the company to pay off all of their debt net of cash on hand. And this metric correlates to dividend safety, balance sheet strength. This tells us it wouldn't take ASML not even 1 day to pay off all of their debt net of cash on hand. Very, very strong balance sheet. Now, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we talk about severely undervalued stocks that deserve your attention, as well as what's gone in the market over the last few days. So click below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each, the upside that Wall Street themselves see over the next year. And on top of that, speaking of Wall Street, you can get a spreadsheet of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So click below, sign up, and you can start reading straight away. We then look at the institutional ownership that sits at 26%, around 7 billion of sales over the last 12 months. A little bit more buying over the same time frame, and in fact what's very interesting to note, for the first time since Q4 of 2023, institutions have sold more in the more recent quarter than they have been buying. Now yes, over the last 12 months, net position is a net buy, but over the more recent quarter, we do see quite a significant, in fact, more amount of sales than buying. Remember though, whatever the institutions do, always do your own due diligence, never blindly copy what they do. We also want to point out, we've looked at their top line revenue, which we said was very, very good. In fact, very attractive over the long term, as we can see from the graphical basis. but ideally we want to highlight their bottom line net income. Does it follow a similar trend? And the answer is yes. As we can see, very nice growth. Always look at companies, not just their revenue, not just their margins, but also their bottom line, going from 1.7 billion in 2014 to 8.7. So growth does look very good, especially if they can continue with this upwards momentum. Then we want to just show you and highlight how strong the balance sheet is. As always, cash versus total debt, quick health check. When we look at it from a graphical basis, it has been increasing over the longer term, nearly double from 3.4 billion in 2014 to 5.6 billion in the latest quarter. Now remember, as always, one number will not tell us anything, which is why we compare it to their total debt both numerically and directionally. And what we can see, it has also increased around 1.4 billion. In fact, graphically we can see that, to essentially 5.2 in the latest quarter, pretty much around the same amount of cash they hold. So like we said earlier on, it wouldn't even take them one day to pay off all of their debt, net of cash on hand, looking very, very good. Now let's get into their valuation. They get a D-. P on a non-GAAP forward basis at just under 33 is essentially above the sector median of 24. So if you're buying ASML today, you are paying essentially a premium to the overall sector at nearly 36%, something that you can see no matter which valuation metric you use. But as we always say, sometimes companies do deserve to be trading at a premium. Likewise, companies sometimes deserve to be trading at a discount. We then move on to the growth grade where they get a B. Now year-on-year revenue growth, negative 2%, below the sector median of positive 4%. We see the revenue growth at 14 over the next year, in fact significantly better than the sector at 5.64. However, when we do look at the earnings per share over the next 3 to 5 years, it does look better than the sector, but only marginally at 17% above the 15.09. Then we get to the profitability where it looks very strong with the A+, 51% in terms of their margins on a gross level, a little bit better than the sector at 50.4, but their bottom line looks incredibly good, 26.4%, significantly better than the 3.6 of the sector median, as well as their cash from operations, 5.4 billion over the last 12 months versus the 92.94 million that we get for the sector. So quick recap for this part, a double buy from Seeking Alpha and Wall Street, a hold from Quant, D- on valuation, B on growth with an A+ on profitability. Now 2 more things before we jump into our own valuation model. What we do note here, comparatives performance against others in the semiconductor space. And over the last year, total return, meaning including dividends reinvested, ASML very poor, negative 1%. But what we can see, some of the comparables here today haven't been performing that good either, just over the last 12 months. When we zoom out over the last 5 years, we see a lot better. ASML itself up 154%. Then we zoom out even further, and what we note here, pretty much any company you would have selected out of these, you would have been very impressed with. ASML itself just under 600%. Remember though, past performance has no indication on the future. They could perform a lot worse. In fact, they could perform much, much better. Finally, just want to show, although I'm sure by now you know what the result is, the comparative against the S&P. Over the last year, well, it is down negative 2%. Over the last 5 years, massive outperformance. Over the last 10 years, again, the same to be said. But always question, if you are buying individual companies, have that confidence that you do think they will be able to outperform over the longer term. Otherwise, considerations like vote may be appropriate. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value today derived from the DCF model. We're going to show you how we got to it. We have the free cash flow year on year, average growth over the last 10 years at 35%. We've gone for 20%, which is the medium rate out of the low, medium and high today. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, the intrinsic value indicating $1,128, which implies 70% upside. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for ASML or any others that you do desire, but we'll show you essentially for transparency at the 15% rate, $834, 26% upside, and at the 25% point, 1,517, indicating more than a 2x from here at 129%. So we're going to take through the medium rate today at 20%, And as always, we like to apply a margin of safety where we use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $1,015, then we keep going till it's near the current trading price, and what we can see for ASML, that is pretty much trading right there at its 52-week low. Right now, you would be getting at least a 40% MOS up to $677. We can see at the 45% point isn't quite there yet, so 40% MOS for ASML, the semiconductor company, and Wall Street, their price target $920 over the next year. They see upside of 39%. As always, give us your thoughts whether or not you believe this is a buy, maybe a hold, or even a sell, whether you believe some of the bearish indicators will actually affect this company enough that it has put you off, or maybe you are very bullish on this space over the long term. And we have seen articles like Bloomberg, like PwC, who believe this space will grow at around 40% on a compounded annual growth rate over the next 10 years. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click below, sign up to the free weekly newsletter, and come and join us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.